Can they pay their bills in the short term? Think liquidity, okay? So that's what one of the things creditors are looking for. And there are ratios that we're going to go over later that evaluate things like liquidity, not just by looking at actual cash on hand, but looking at it versus other items on the balance sheet or income statement, okay? So this is a very important thing. If a creditor decides to extend you credit, something as simple as, you know, if you work in a business and you want to go to the local hardware store and buy equipment and not have to pay for it right away, these stores have to decide to extend you credit. All right. So in order to do that, they will evaluate things like your liquidity to determine whether or not you're worthy of being able to pay in 30 days or if you have to pay right on the spot. Okay. And these are things that you earn. Have you guys ever heard of Dun & Bradstreet? DMB? So like that's a popular tool. A lot of companies will use. They put themselves on Dun & Bradstreet to have their credit evaluated. That way they can become more credit worthy and be able to get businesses to extend them credit. Okay. So does the company have a lot of debt relative to assets? Companies with higher debt are relatively more risky because they have more assets have to meet these fixed long-term obligations. So we're talking about long-term solvency. So what I want to say about this, so what comes to mind for me, which is not really a great example of what's on the balance sheet, but for some reason always just pops into my head when I think of this. So we say here, if more assets have to meet fixed long-term obligations. So don't take this at the very, very at face level. I'm not like saying anything political. I'm not saying that our government is failing, nothing like that. I'm just trying to like give you a sense, and it just seems like very tangible. So when we pay our taxes in every year, a lot of programs that the government runs have been set up forever, right? Like Social Security, right? So whatever we put in for our taxes, a lot of that goes right away into Social Security, right? A lot of what you pay is put aside for some government program that's already there that we like, you know, they say, oh, we should reduce spending here and spend it here. There's like, you know, if there's like a pool of like, you know, that goes from 0 to 100, like maybe like 85 of it is already allocated by things that are fixed costs. Like we can't do anything about it. So what we have discretion to spend is much less, right? So you put a lot in. So here, if a company has a lot of cash or a lot of stuff coming in, but it's like fixed for certain purposes, you have very little discretion on what you're going to do with the rest. This could impact your ability to continue in the future if you have all these fixed costs, right? Okay, so it can affect long-term solvency. All right, so I'm not saying anything about the government. I'm not making any statements. It just, you know, that's what always comes to mind when I think about, you know, just having a lot of fixed costs that you don't have a lot of discretion on what to do with the rest. Okay. So, and obviously, if you have, depending upon your liquidity, depending upon how much of your assets are fixed for spending on certain items, this can affect how flexible you are financially. And how flexible you are financially may impact your ability to get additional loans. Okay, so if you have, if a creditor gets the sense, or not the sense, that they look at your financial statements and they see you have $10,000 coming in cash flow every period, and $8,000 of it is already allocated to other loans and other fixed costs that you have, are they likely to lend you money? Because you may not have enough, depending upon what you want to borrow, you may not have enough financial flexibility to really be able to take on new loans and be solvent in the future.